Hello and welcome to the i3 podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. There you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show. Welcome to the i3 podcast. I'm here today with Sean Anthonisz, who is the head of investment strategy at Mind Super. Sean, welcome to the show.
Thanks, Wouter. Thanks for the invitation.
You're welcome. So, most of our guests have a purely investment background, but you also had for a long time still a foot in academia. And I think when we first met, you were still full-time at the University of Sydney. Can you tell me a little bit about how you look at investing with sort of that academic background? Do you look at things differently than perhaps some of your peers and colleagues?
Yeah, interesting question. So I'd say in many ways you can, and regardless of the path you take, you can end up in a similar place with similar conclusions or similar philosophies. But certainly from an academic perspective, I've picked up a lot of knowledge, tools, understandings that I've brought into the investment space, and those insights have been very useful, mostly around testing hypotheses, questioning ideas, also understanding the extent of problems like p-hacking in the academic literature. And
p-hacking, what is that?
So p-hacking is a process that really results from incentives. So if you think about the problem that most academics have, they're trying to get published. Publishing well in good journals is a pathway to promotion. So, but there's an effect that goes on with journals, which is that if you have positive results that either confirm your model or the model of someone else, you're more likely to be published than if you have results that are unclear or ambivalent. And so what this brings about is p-hacking. So what happens there is that academics will filter the sample, they'll change the start and end point, they'll change the method by which they perhaps calculate risk variables, they'll put in extra requirements to filter out small stocks, large stocks, or banking stocks, all these sorts of things that go on, until they get a sample set that actually confirms the hypothesis. And so this is called p-hacking. And the critical values for p are usually 5%. People love to get 1%, but usually it's 5%. And what that means is there's a 5% chance that this outcome could be just purely by chance. And so that's a threshold. That hacking can lead to conclusions. You think something works, you read the paper, it seems like it works, but actually it may be a result of p-hacking.
Sounds a bit like data mining in investing.
Yeah, I think in investing it's you hear data mining or curve fitting, but there's a distinct difference, right? Because, and this comes down to this agency issue. So if you think about an academic, if they write a paper and it does involve p-hacking, the chances that there's any repercussions, any challenges that come along are fairly low. And so that doesn't have many consequences. But of course, in industry, if you do data mining or curve fitting for building, say, systematic trading strategies, at some point that'll come unstuck. And of course, you will bear the risk. And that may have implications for your career or your group or your team and so on. So there are differences in incentives.
Yeah. So let's take one step back. You sort of went in and out of investing, I think, and academia during your career, because I think before the University of Sydney, you also worked for a hedge fund. Can you tell me a little bit about how you got involved in investing itself?
Yeah, okay. Well, maybe that starts with that the beginning of life at university. But unlike, I guess I was the antithesis of what modern universities sell, which is, I went into university with no idea of what I really wanted to do. I was good at maths and physics, and I really loved English. Couldn't do the English component, so I was stuck with the sciences, and did an honours thesis in pricing interest rate options, and ended up being sucked into an investment bank. And at that time in history, there was a big need for mathematicians to price exotic call options and price interesting swaps and so forth. So I was brought in to do that, and ended up trading, ultimately the sort of term structure of interest rate volatility and developing systematic strategies for trading derivatives. Yeah. So that was sort of the starting point. Went from banking to the hedge fund space. But one of the interesting things I found, and this is, I went to the US, and one of the interesting things I found in the US was that many people at this point in time had PhDs in senior positions, so I needed to get a PhD. So I decided also for family reasons, come back to Sydney, do a PhD, with a plan that I'd go back to industry. But what I discovered was there's really interesting academic problems, and they were not in the areas that I thought I would be interested in. They were more in asset pricing, which has a lot to do with portfolio construction, of course, but less to do with systematic trading, which is something that I was, mainly occupied with in industry. So I stuck around a little bit in academia working on those problems, but was continually getting asked, would I be interested in this or that? And of course, superannuation came along. The CIO of Mine Super at the time gave me a couple of taps, and it allowed me to bridge the two worlds for a while. But obviously today I'm fully at Mine Super.
Yeah. So you did for a while where I think you were one day a week still at the University of Sydney's business school. And when we first met, you did some research into how good actually are asset owners in picking managers rather than managers picking stocks. Can you tell us a little bit about what you found out there?
Oh, well, most of that research at that time was more about trying to explain, I guess, not just the alpha that managers get, but the variation, the residuals that managers see, and trying to explain how does that relate to fees. So if you're thinking about how good people are at picking managers, you would expect fees to be associated with performance, higher fees. That's a natural equilibrium, right, that you would expect to play out. And the academic literature has long demonstrated that this relation doesn't seem to exist. But what our research managed to show was that there is some correction, I guess, to that relation that goes on if you lock in on the idea of bad states of the world. So the idea that people pay away, they're happy to pay higher fees for managers who perform during times of crisis. So that might be times where financial stress is high or recession and so forth. So that sort of changed my view a little bit on that relation. It's still not a strong outcome. It's still the broad cross-section of funds. It's a difficult thing to explain. But I think, as we all know, if you and I think, Walter, you know this as well as I do, that if you're looking at a very, very large pool of investment managers, well, of course, on average, they won't perform because you've got fees at play. But the real trick is trying to identify the best of that crop.
Yeah, and I think you got some new research coming out as well into that.
Yeah, working with a guy named Chris Glover, who's a financial mathematician at UTS, and also one of my colleagues at Mine Super, Waiting, who's a quant. And our work is on the idea of really the manager selection problem. So often this debate around active passive has been highly polarized. It's you're either a believer or not. And the truth is obviously, to me, it's obviously somewhere in the middle. So our model is a model where the investor is choosing a manager, and they're ultimately then determining through time, is this manager a good manager or not? And that is indeed the problem that asset owners have. They choose an active manager, they monitor performance, and then at some point, if performance is not sufficient, they might make a decision to terminate. So what our model is trying to do is capture that decision-making process, but also the costs of termination. And I think that's something in the debate which is often lost. People ignore it, and it becomes a manager by manager proposition. But that's not what asset owners do. We manage money for very long periods of time, and we're allocating to different managers through time.
So in that debate between passive and active, you should not only look at manager fees, but also at the fees of transitioning, of termination, of reallocating the capital, basically.
Absolutely right, Walter. I mean, it's and often, those things go hand in hand. So, the alpha you might get from a manager, for example, in small caps, you would expect to see that in small caps because you expect to see higher informational, inefficiency, I guess. But of course, the liquidity is lower, and that's related to informational efficiency. So if the liquidity is lower, then your cost of exiting that manager and transitioning can be a lot higher.
Yeah. So what sort of practical implications does that have? Does it mean that you should set the threshold for firing managers higher?
Yeah, there are some very interesting practical implications. So one is you don't want to fire a manager too early because the costs are so large, and the costs must be integrated into that decision around firing. But the other aspect is uncertainty. So we tend to be pretty good at point estimates in industry. We're pretty good with saying, we think the alpha is 20 basis points per annum. But what we're not so good at is identifying what's the probability of that being true or just chance. So again, this goes back to P statistics, P values. So a manager can't P hack their track record. It is what it is. But an allocator can look at it and assess, the statistical likelihood that this track record is being generated by genuine skill or and capability, or is it really a result of just being a little lucky?
What can you say about sort of timeframes in assessing those managers? Because we looked a little bit in the past, our former columnist Daniel Grioli, the Market Fox, looked into, average time it takes to have some statistical significance around a trend and performance. And he basically concluded that it takes multiple years before you can actually tell whether a manager is lucky or not, and not just the 3 years that sort of seems to be a standard for underperformance and termination.
Yeah, that's a good point. And I think determining whether a manager has skill or not, it's not just statistical, right? So there are a bunch of other due diligence processes that go on. In the paper I've working on with Chris, and Wei Ting, that paper incorporates this idea that there's an evolution in your beliefs about a manager. It's not just coming out of a pure statistical piece of analysis. So that those beliefs could involve conviction around the manager's skill, staff coming and going, the technology they're using, whether the edge they've developed is now something that everybody has. All those things can be part of that picture. So I think that's important. And similarly, if you get a p-value for a manager that's very low, you think that their alpha you're very confident. You have to put it in context. It could be that 15 years ago, 10 years ago, the markets were very different and they had a certain edge around data, which is no longer an edge.
Does it also depend on the different styles of managers? I can remember we talked a little bit about looking at value managers, that often their outperformance is quite lumpy. And so if you invest just after that outperformance, then you're unlikely to get a great result in the next couple of years.
Yeah, I mean, this falls into a couple of categories, but certainly if you believe that there's some sort of mean reversion going on around the drivers of performance, then clearly chasing performance will lead to some not so favourable outcomes. But having said that, a lot of the factors that we use, the value factors, and a lot they change significantly through time. They're different across managers, the way people calculate them. But also managers themselves, if you look at the performance of a manager and you think, oh, well, that's going to mean revert, they've done very well, now they should do poorly, or vice versa. Well, you have to think about the economics of that. And if their stock portfolio is actually static, then maybe that's a reasonable thing to examine. But if their stock portfolio is dynamic, then that may not make sense. So why would past performance, why would mean reversion play out if they're rotating through different stocks necessarily? But it is a consideration, I think, that's worth making.
Yeah. So there's a couple of points that you look at manager selection, but when you sort of think about the difference between an academic approach and sort of a typical investment approach, I think you said in the past that there seems to be a lot of folklore in the investment industry. Can you go a little bit into that?
Yeah, well, look, I'd love to take a responsibility for that, but I'm pretty sure that was Sue Brake. I think at the time she used that at one of your i3 conferences, used that term, and I really stuck in my brain. But it is really a question of assessing what you hear and what you're told and the conventions that are at play. So there are things that are made that people make statements that, oh, this always holds true, but it's worthwhile just having a look and examining with the data if that is the case. The periods upon which that was the case, is it a conditional kind of outcome? And I think that's one of the things where an academic perspective is useful, where there's a natural instinct as an academic to unpick and test hypotheses and question results. And that's not a bad discipline to have in investing.
So are there any sort of myths that you still see being used in the industry today that you want to bust?
I don't know if there are myths. I think it's more, I guess, practices and processes around how we allocate money. But there are sometimes conclusions drawn from fairly loose graphs that don't necessarily bear analysis. But that's not just an industry or an investment problem. It also shows up in a regulatory setting. So we have seen publications from regulators where they put out some very interesting graphs involving size and performance and draw a kind of a weird curve through them in an arrow and say, see, size means you're better. But the academic literature says that might not be clear. But also that work has no statistical basis. It's just a graph.
And that also seems to be different for different asset classes, because I think most people are aware that, size in equities investing is actually detrimental rather than a positive thing.
Yeah, and look, most of what super funds hold is certainly in the high growth end is equities. Size is detrimental in that area. Obviously, small caps is a problem, but in credit or in the sort of bond space, fixed income, that size is less an issue. These are very, very deep, massive markets that are less challenging to get set in terms of size. But still, there's a problem there, right?
Yeah. So you started off with more of a quant focus. Now there's been a lot said as well about quantitative approaches, factor investing. Where do you see the most useful applications of quantitative tools in investing?
Yeah, I guess this goes back to a little bit to investment philosophy, but for me, the most, when people talk about quant investing, it's often, well, how can I make money? How can I make alpha? Where can I develop a quant DAA program? Can I forecast expected returns in the short term better? These are all ideas, but I think where quant analysis is most useful is staying away from problems. And so there are a bunch of ways that you can test theories, ideas, and you can get measures of uncertainty around estimates, and that's really useful for how much conviction you want to employ on strategies or on a particular strategic asset allocation even. So if you say the expected return on Australian equities is, say, 6% over the next 10 years, 6% per annum, how certain are you of that? And what is the range? And I think that's an interesting question to ask. We try and put numbers on that. We use an ensemble of models that gives us a very broad range of outcomes, but we also understand the limitations of those models and what slight changes in parameters might mean for outcomes and so forth. And that gives us a real sense of the uncertainty, and it is pretty large.
Yeah, yeah. I suppose there's always a lot of uncertainty in trying to predict the future. But I think another interesting concept as well that you've addressed in the past is that once you start transacting, it changes the game. And I think you used the phrase is that the system is aware of its own data. The moment you start doing something, the game changes. How does that feature back into sort of predictive models?
So I guess I think back to the early part of my career. So when I was doing a lot of quant derivatives trading, and it was very clear early on that if you backtested some fairly accessible, fairly easily implementable trading strategies, that those sort of things attenuated with time fairly quickly. So you tended to focus on more computationally intensive, less accessible, less liquid opportunities to avoid that competition. So that meant things like trading the skew and the term structure of volatility, moving into interbank markets and trading commodity futures at times when liquidity may not really be that great. So there is that aspect of being aware of the competition and being aware that other people are looking at data. But there's been some really interesting stuff come out of academia itself. So in many academic publications, or the ones that I tend to look at, they focus on anomalies, asset pricing anomalies, and they're almost entirely in equity and mostly US equity markets. But studies have shown that the profitability of those things attenuate with time. And so the question is why? So, harping back to a little earlier, it could be because of p-hacking. It could be that the results were not actually there. The anomalies weren't genuine anomalies, but it could be also because of another reason, and that is that more sophisticated institutions, hedge funds and the like, are reading academic literature and testing ideas and that come through, testing anomalies and seeing if they're genuine, and then trading those anomalies and trading those opportunities away, and therefore the literature is now showing that these things attenuate. So there's a really nice paper that's come out that sort of goes that extra step. It's a few authors at the Smith Business School in Canada. It's a management science article from 2019. And it's titled something like When Anomalies Are Publicized Broadly. And they use this 13F data, SEC 13F data, to demonstrate that institutions do actually trade these anomalies away, at least to a large extent. So what's really interesting then is, of course, the quants are reading this research, which is about awareness of information and data. And so now we're going to that sort of folded next level where the quants are actually aware of the way that they themselves are behaving in response to new ideas and trading opportunities. So I think this is a really interesting time.
Yeah, I think similar comments have been made around sort of the option pricing model, that before it sort of was commonly used, there was some criticisms about whether it was actually an accurate reflection of the option price. But once everybody started using it, it sort of became a self-fulfilling prophecy where, that was the main method and there was an absence of anything better. So,
yeah, I think that's possibly true. I think I remember reading some, this is a long time ago, but reading something that some of the early estimates weren't too bad, right? They were not too far away from what Black Scholes was going to throw out. And that's not too surprising, really, because if you just take a simple approach, forget about risk-neutral probabilities, just take physical probabilities and you price back the outcomes, then you're going to get a number that's not that wildly different. But I think where the bit of the Black Scholes model that I find very interesting is the way that industry very quickly realized that it was pretty good, but it also didn't really fit the market, and it adapted its use of the model to accommodate that fact. So the skew is something that's really important in options trading. So typically, you might see in the equity markets that call options are skewed down. The volatility associated with, if you price the implicit volatility, if you price those upside call options, it's lower than the implied volatility of the at-the-money options, and similarly puts are more valuable. Their volatility is priced up. So the market adapted to that, but then used the language of Black Scholes, right? So it kept the model, but said there's a skew, and the skew's worth this or that, and there's a smile in some markets. It's a simple, it looks a little bit more like an arctan curve in other markets, right? So there are different skews in different markets, and this is understood, and people trade it. So I think that's one of the great things about finance, or theoretical finance, is it gives you a model. The model doesn't have to be right. It's just a reference point.
Yeah.
And then you've got a language.
Yeah. So is investing an art or a science in that degree?
Well, I think it means different things to different people, right? So, and there's a real difference between what we would like to do and what we actually do, right? Because we are humans. So yeah, investing, in practice, it can succumb to things like folklore and behavioural biases. They're a big part of the problem, and that's where data-driven processes are really useful. But ultimately, investing is a human activity, right? It's finance is a social science. Investing is human. It's subject to those issues. But then structurally, we have agency issues everywhere, and that happens, for example, with the principal agent problem with us and an investment manager, or even internalisation issues with large super funds, right? They've got this a similar kind of moral hazard issue potentially there, which they have to navigate and to build processes around. So it means different things. From my perspective, it's always been about using science to avoid problems, not using science to tell you the future, right? And I think that's how I characterize it. So that may not be helpful for a lot of people who want one answer. They want the science answer, or they want the art answer. I'm going to say I'm somewhere in the middle.
Yeah, fair enough. So I think you're now full-time at Mind Super. Can you tell me a little bit about some of the investment challenges that you're working on from the Mind Super perspective?
Yeah, I mean, well, it's no secret that there's a merger potentially underway, so that's obviously there, but and that will generate a lot of work. But I guess from an direct investment or an immediate investment perspective, it's looking at low latency ways to shape our fixed income book. That's something we've been working towards for some time.
What does that mean, low latency? I only heard that being used in reference to audio.
Audio, okay, yeah. Well, for us, it's about let's put it this way: you can have all sorts of views on the market, but if you can't implement, then why are you even developing views on the market? And so we would like, we can at times develop views on the fixed income market, the constituents of that, and we would like to explore those views. But the latency we face is, if you're using external managers, it takes time. It's transition costs that we spoke about are at play, and the timing is a real issue, because once you go through this due diligence process, contracts have to be signed. There's a investment governance, umbrella around all that stuff. And by the time that happens, what have you left on the table? And we've experienced that in the past. During COVID, we did quite well in credit markets, but we could have done so much better. And so we are looking at ways of how can we get our views in place fairly quickly.
So is this a sort of a dynamic asset allocation or strategic tilting process?
I'd say it's more like a TAA than a DAA. Everyone uses these terms interchangeably. So for us, DAA is really making investment decisions at the sub-asset class level. So that would be things like tilting into EM equities and less into DM, or vice versa. And so we would call that a DAA play. But TAA is more about stepping into those sub-asset classes and making calls like, high yield versus investment grade versus sovereigns versus different parts of the curve, potentially different industries. So we'd like to be able to explore that. And again, you know, this is one of the problems that we've identified, is that if you think about the way a fixed income manager operates, you give them a mandate, they're managing a tracking error, they've got a benchmark, they may employ some fairly well-known methods to generate alpha, and you know, you should be happy with that, right? But there are times where you would like to tilt really heavily into certain parts of the market, and that's our ability to provide liquidity, right? We can, you know, super funds can provide liquidity and exploit those opportunities, but the manager doesn't have a strong incentive to do that, and they're constrained anyway. So because of the mandate that they're operating under, so we are looking at how can we structure things a little differently.
Yeah. So does that involve getting some delegation back from sort of the investment committee and the board?
We've got that delegated authority around TAA and DAA within constraints, so that's already set in place in our investment governance framework. But this is more about how do we execute, how do we implement, and that's one of the challenges, right? You set up an investment governance framework, you think you're pretty happy with it, but then if you can't implement, then why even bother? So we are trying to get that in place.
Yeah, so to become a bit more nimble in execution. So MineSuper is an interesting fund in the sense that, you know, it's an industry fund for the mining industry. And these days you can't do a conference, including ours, without touching upon like, you know, ESG and decarbonisation. How do you tackle those problems with the context that, you know, knowing what your member base is?
Yeah, I mean, you know, our members are from the mining industry and obviously a large number from coal mining specifically. I guess you think about it from a very headline level. Obviously, coal mining and mining more generally are really important parts of our economy, really important industries. And our fund has a really long heritage in mining, right? So we've been around for 80 years and we've been serving our members over that time. So, we have a strong connection with our members. And we obviously know that the money that we manage belongs to our members. It's not my money or the director's money or anyone's money. It's our members' money, and that's first and foremost. And the fund's very, very clear on that. So look, on ESG, we expect our managers to manage ESG risk. You know, we're cognizant of it, and we ask them about what they're doing in that space. So it's not like we ignore that. It's a very important thing for us. And we're monitoring the carbon intensity of our portfolios wherever we can. So in our equity portfolios, for example, we're actually below benchmark in terms of carbon intensity. So I think people, it'd be wrong to think that because we're MineSuper, we don't care about ESG. That's just simply not true. And look, we're not averse to investing in opportunities in energy transition. So we're certainly in that space. But having said that, we aren't committed to net zero portfolio construction, and nor do we specifically avoid fossil fuels. We haven't. The fund hasn't taken that position, and they continue to support the industry. And that's for us. Our members, they're obviously will be subject to change in any type of energy transition. So the view of the fund is we support a just transition as the global economy progresses towards a low carbon future, and I think that's the fund's position. So we acknowledge change. We know it's happening, but we are very supportive of our members and of a just transition. So beyond ESG risk, we're currently building out our ESG stress testing framework, and so later this year we'll have that in place, and that uses the NGFS stress testing scenarios, or NGFS scenarios, to stress test our portfolios, and that's going to be challenging. Private markets are very difficult to assess the ESG characteristics of, but we think we've developed some reasonable proxies and approaches for that.
Yeah, and also from an asset allocation and risk perspective, decarbonisation is an interesting problem, because I think it sort of became clear at the start of 2022 with the invasion of Ukraine and the energy prices, what happened there, that portfolios that were already quite aggressively decarbonized turned out to have a bit of a growth tilt, and so could struggle in periods where value does better. How do you think about that? Is there a more sensible way of doing that?
Well, there's a couple of thoughts there. One is that you have to identify. I think many other super funds have this they have this issue far more acutely, which is if you make those kind of commitments towards net zero, your tracking error against these benchmarks will be large. Obviously, that has a your future, your super tracking error consequence, which is another issue. So you've got that's one of the things that's happened in superannuation that's really fascinating, is things that were largely distinct are now interacting. So you've got regulatory risk and the possibility of the regulator changing the test. What does that mean? You've got things like early release, which we'd never anticipated, and what does that mean for the future coming together? And then you're running a fund you've got an investment objective, a CPI plus investment objective. You've got peer relative comparisons, and you've got the heat map YFYS. So you've got this triangle of joy to operate in. So it's complex, and I think for anyone, if you're stepping away from carbon intensity, that's what will come with it, and that's shown up in when with some of the debate around the YFYS test. That's been a feature, right? If funds are making a stand based on their membership or the people that they're trying to appeal to, how do they get measured for performance? It is a problem. But having said that, eventually, if the economy does, you had someone recently on this podcast, I think, talking about fission, right? So, if you think about fission and the possibilities for the future in energy, eventually the economy will make transitions towards that end, and the market will adjust for that. Right? It always has and always will. I guess some funds think of it would take it as a cost of capital argument, and net zero as being part of that. For us, it's more about a just transition and an awareness of the risks that ESG poses.
Yeah. So you are full time now with MindSuper, but you mentioned there's still a paper coming out on active, passive, and the cost involved in that. What else is on your agenda? Are you planning to publish more papers or continue to publish papers?
Oh, look, I think I'll continue to do research. I enjoy working with my co-authors, so I'll keep doing that. I've got co-authors at UTS, Monash, and University of South Australia. So I'll keep working on with those guys. It's really fascinating work. I really enjoy the interaction. It's very stimulating, there are some very interesting debates that come out of those conversations. So I'll continue doing that. I'll still have some engagement with universities, and for example, the maths department at the University of Sydney, which is sort of my origins, right? I was a mathematician, so they have a unit there on financial mathematics, which I've provided guest lectures for in the past, and probably will continue doing that kind of thing for students. But the role I've got and the challenges that we've got ahead at MindSuper, we've got a merger potentially to work on. I'll be fairly occupied, I think, over the next couple of years.
Fair enough. Maybe we can finish up with a little bit of crystal ball gazing. With that sort of 1 foot still in academia and finger on the pulse, where do you see some of the more interesting innovations? Is that we heard a lot about machine learning in recent years. Where do you think that the more interesting innovations will come from?
I think the most interesting innovation, machine learning's been around for a long time, right, in various guises, and that's in the 90s we called it neural networks, and it is what it is today. But I think what's clever about today is the the nuances in the methodologies and the ability to try and test the model to understand what it's really doing. And I think that's something we never had in the past. It was just a bit of a black box. I think that area is becoming less problematic. So I think that's an opportunity. But there's still, no matter what model you use, you're going to have a tremendous amount of uncertainty about the forecasting, and I think that's where I think understanding what the model's doing, but also getting out of the model some understanding around uncertainty is going to be paramount in applications of that.
So it comes back to that initial philosophy that you were talking about, that all of these tools are basically to help you avoid problems.
Yeah, I think that's true. Yeah.
Well, Sean, thank you very much for your participation. It was an interesting discussion.
Thanks, Wout. Always nice talking to you.
Thank you for listening to the i3 podcast. For more information, please visit www.i3-invest.com. Thank you very much.